Goldman is warning that the next 2 weeks for the markets are going to be hell. I'm going to show you why this could be just the beginning of what's coming for investors. Not to worry, I'm going to show you where the opportunities lie and what you need to do right now. Let's turn to Goldman, where we picked today's story up with their back to school special, because what they're saying is we're facing now the worst 2-week period of the year. And that's just the beginning of the story, because systematic demand has also dried up, and that's been a key piece of support for the markets. On top of that, institutional investors have net sold U.S. equities for 2 months straight. But here's the problem. They're not the only ones selling. And despite a continued market rally, hedge funds are also on track to sell U.S. equities for a second consecutive month. This has been driven by short sales outpacing long buys across both macro products and single stocks. And this is pointing to a more cautious stance by professional investors heading into what is the worst month of the year. But this is simply a seasonal issue? Not even close. What they're worried about is something far worse. We'll take a look at that in the moment, but let's dig deep into the flow of funds, because for most investors, history says they're going to see a big negative number on their statement by the end of the month. But one of the issues Goldman is flagging here is that the S&P has already rallied 34% off its low print in April and generated a year-to-date return of 11%. And what they're indicating is going to be really hard for that to continue, because when you look at earnings growth of the U.S. versus the rest of the world, you can clearly see on this chart that we've completely outpaced everyone. And that's what Goldman's suggesting here. Is going to be really hard to continue this trend. But something we think is about to surge a whole lot higher, that is the stock for our sponsor for today's show, Avicanna. Again, you can find them on the TSX under symbol AVCN and on the OTCQX under symbol AVCNF. Let's take a look at this chart, because every time you see their stock trading down in the supply zone, it tends to surge higher. And right now, the opportunity is sitting right above its 2-year volume profile, meaning there's been a lot of buyers here over the last couple months. And if the stock was to break out and head up to that upper supply zone, you're looking at a potential 80% move. And again, everything you need to know in the pinned comment and description below. Stay tuned to the end of the show for more information. Because another risk is the Fed. And we've been talking about how they're now setting up for a potential rate cut at the end of the month, but it would be all due to weak payrolls. And that is another major problem, because when you look at Fed cycles, they usually go farther and harder than the market expects, and that's because the market is never prepared for a recession or a financial crisis. And again, that is perhaps the biggest risk here, because on Friday we're going to get the next non-farm pay report, and then the week after that we get the QCW revisions. It's all likely to say that the U.S. labor market is far weaker than the market is expecting. But let's take a look at this next chart, because the risks start to get very clear here, that when the Fed is cutting, it's not a good sign for the stock market or the economy. And you can see very clearly, going back to the dot-com bubble, the Fed was cutting, and yes, the stock market rallied a bit, and then it came crashing down. Same thing happened during the global financial crisis. It didn't happen going into the pandemic, and that's one of the reasons here investors are very bullish. They're not understanding the real risk. And we did talk about this last week, at how on the onset of the first Fed rate cut, you have on average potentially 3 months that the market could go up. But remember, that's not a guarantee. That's an average. It doesn't mean it'll happen again. And this is why Goldman is warning and telling everybody, look, you can stay long this market, but do so with a hedge. And they're saying hedges are cheap right now. If you're saying, look, Steve, I don't know how to hedge my portfolio. Well, one of the ways you can do it is you could raise cash. You could perhaps buy some treasuries based on the fact that you might believe the Fed is cutting. And if there is a correction, you can use that cash or sell those treasuries to buy back in the market. So there's a lot of potential opportunity here, and I want to show you where that is at. But first, I want to show you where there's some risks, and this is one I've been worrying about, and it's all about breadth. And hold your breath, because what we're seeing here is the S&P 500 breadth is rolling over. Now, I want you to understand the chart you're looking at here is we're going to see the percentage of the S&P 500 that's trading above its 50-day moving average. Now, if a stock or an index is above its 50-day, it's considered bullish. If it's below, it's bearish. And I want you to keep in mind, where breadth goes, price does eventually follow. And that's a risk here, because we've seen the S&P drive to new all-time highs as breadth is rolling over. And again, that's a major red flag. Let's take a look at our screens here because right now momentum is still positive, but that's likely to turn soon here. Now, how did we know that? Well, we look at the technical indicators. We can see the RSI is above 40. We can see the trend is still positive, and that was validated by our own Momentum Timer Pro report. And from a machine positioning standpoint, again, we'll look at Goldman's data here in a moment. I want you to see that we modeled that machines were going to go max long because we run a historical overlay on our reports. Now, whether you want to trade the momentum signals or machine positioning, you have links in the description below. You can jump on both of our reports right now, and for 30 days, you don't have to pay a dime if you use a coupon code. And while you're there, check out Avicanna. Let's take a look at the chart here of SPY because I want you to see that it's very clear that you can see the selling that's been going on by institutions and hedge funds, and the evidence is very clear. If you see that red bar across the top, well, that is the 6-month volume profile, and that is where the most shares have been traded over the last 6 months. So who's buying this market? Well, it's retail. The risk is if you see the S&P close below its 6-month volume profile, it's a very bearish signal. At this point, it's retail holding this market up. But the question we're asking now is for how much longer? Let's take a look at the breadth of the NASDAQ because I want you to see this before we look at the machine positioning data. And while the NASDAQ pushed higher, breadth did not. It's been flat here at around 50% for the last couple of months. And again, you talk about warning signs, it's very clear where breadth goes, eventually price follows. Let's take a look at our screens here on the NASDAQ because we've seen a shift in momentum. We now have one consecutive daily sell signal. We see machine positioning. Again, this is our modeled historical data saying the machines are likely to be sellers here and for good reason. Let's take a quick look at the price chart. We get a little different perspective here over the S&P 500, and you can see you got a little left shoulder, maybe a head, a right shoulder here, but this isn't a big deal. The big deal is you have the 50-day moving average and the 6-month volume profile all at the same point. Again, you get a close below this and you start to understand very clearly it's the pros that are selling and offloading onto retail. Let's talk about Goldman's estimates on their machine positioning, and what they're saying is, look, CTAs bought $12.56 billion worth of U.S. equities in August, and now they're at max long positions, just as we modeled they were likely to do. Over their next week, they model they're going to be buying less than $2 billion of global equities and less than $1.5 billion of the U.S. Over the next month, less than $2 billion in global equities and less than $3 billion in the U.S. So any hope now that the machines are going to drive the markets, it's just the opposite. They're likely to be sellers going forward, particularly if you see price drop. Because something you have to understand about machines, they chase price higher, but they also chase it lower. But something we said was likely going to head higher, and it did, was a Russell 2000. Remember, we said not long ago that if there was an opportunity in U.S. equities, this was where it's at. And here's the evidence. We can see that the percentage of Russell 2000 trading above its 50-day moving average is over 71%. And as price goes up, breadth is going up. And again, that is a bullish indicator. Now, we put this trade back on the 25th to our Momentum Timer Pro subscribers. They're already up 1.01%. And I want you to see that this is a live stop loss level. We make trading so easy. We just tell you, here's where our signals are suggesting to buy. You pick the ones you want, and we give you risk control levels. Now, we raise them along the way. So if we see price rally into next week, we're likely going to raise that stop loss level because right now we have it set at our open price to protect our downside risk. Let's take a look at the chart of IWM here, and I want to show you where I think the potential opportunity of where this can go, and that is back to its recent all-time high. Perhaps you're looking at a double top here, and that is where the opportunity is. But again, we're going to be raising our stop loss level right along the way because again, that is a key way to controlling risk. But let's talk about some other opportunity here. It's in the energy markets, and you wouldn't gather this by the headlines because right now, if you look at the energy markets, what do you see? That hedge funds have backed off their oil longs in a major way. And everyone's saying, look, there's going to be a supply gut. But there's one major problem, and that is prices breaking out. Let's take a look at why that's happening and why we flagged that. Here you can see it went out to our Momentum Timer Pro subscribers on the 27th. Now they're up 2.6%. Again, live stop loss levels. Now, how do we know this? Well, we saw momentum rising. We saw the RSI and the MACD were turning higher and the trend. And that's what's key about our Momentum Timer Pro report is it pairs all of that together. And again, this creates incredible opportunities. Let's take a look here at the chart of XLE because you've got to see this. This is quite amazing what's going on there. And it was so obvious when you see the trend lines. Now, once you see we're right now on a 2-year chart, there's a 2-year volume profile, and you can see these purple lines. Let's zoom in because this is called a channel. And what we got was a channel breakout to the upside. Now, something you need to know is we build in channel trading to our Metre strategy, which is incredible. And right now it's included in either of the subscriptions at no additional charge. And this is what's so great about it is because we have this built in. Now, what we see here is it closed above the 6-month volume profile. It's rallied up here and it's squeezing these people who were short and looking to set a big move higher here, potentially even facing hedge funds chasing this one up. Again, love that trade. So even in every market, there's opportunities. And one of we say is probably not worth it. Well, that's the finance sector. Because something that's not bullish for banks, that's rate cuts, but right now it's at all-time highs. If you want to chase here, well, you should use your stop loss levels. Let's take a look at XLF here. Again, this is not one I would play chase with, but if you wanted to, there's your breakout. Again, keep your stop losses tight on that. Let's talk about some other opportunities, because if you're going to play the Fed cutting rates, you want to be looking at the long bond. In fact, this triggered on our Metre strategy on the 29th. It went out to all our subscribers, and right now it's down 0.18%. Again, live stop loss levels. We teach our subscribers how to control risk and make money in the markets. Let's take a look at the chart here, because right now the RSI is at 48. MACD's got a negative cross, but that's not a big issue. We've got one consecutive daily sell signal, but you can see it's been flopping around. But here's a key point. The machines could be buying up here, and that is a big factor to drive price higher. Now, I want you to see this chart here, because you can see it's forming this triangle pattern, and this is very important. You can see it set a bottom and rallied up. We set the top end of that purple line. It pulled back down, and it validated our trend line. It rallied up again, pulled back, and now it's closed right at its 6-month volume profile. So what's the bearish narrative? Well, it closes below that purple line. Bullish narrative closes above that and starts squeezing the shorts out, potentially rallies up to that upper supply zone. So again, if you're looking for trade, you've got energy sector, you've got small caps, you've got the long bond, you've got a lot of opportunities here, and maybe even gold, because it's breaking out too. But remember, if you're going to play breakouts, keep your stop losses tight. Now, right now, the RSI is at 66. You got a positive cross on the MACD. You've got machine buying. You've got momentum pushing higher, and you've got price going right up along with it. Let's take a look at GLD here, because the risk we said was there's like 4 tops. But now it's breaking out, and those who were selling here are going to get squeezed. But again, you want to play chase. All I say, keep your stop losses tight, my friends. But something we made a ton of money on and we celebrated, that was GDX. You may remember this trade. We put a buy it open. It was our Metre strategy trade on the 21st. It got stopped out. 4.11% gain. Again, my friends, it's that easy. We tell you what to trade and give you the risk control levels. But something that could be very bullish for gold, that would be a weaker dollar here, but hang tight. I'm not convinced. Wait till you see the chart. Because from a technical perspective, it looks ugly. You got an RSI at 48, you got a negative cross on the MACD, you've got 4 consecutive daily sell signals, you got machine positioning that looks like it could back off, but when you see the price chart, it says there may be a bullish narrative here, and I'll show you what it is. So you see that green line? That's the 50-day moving average, and right now it's below a 6-month volume profile, but it keeps finding support at its 50-day. At some point, if it continues to do that and it breaks above that 6-month volume profile, you're looking at a move right up to its 200-day moving average. Now, I told you I'd give you a trade from our Metre strategy report. Here it is, Junior Gold Myers. This is going out to our subscribers for a Tuesday buy at open, and you can jump in on this. Here's a live stop loss level, 79.72. Again, when you're chasing breakouts, the big key is you want to keep your stop losses tight. And again, we put these trades out each and every day. All you have to do is grab those links in the description below, use a coupon code for your free 30-day trial. And while you're there, you should check out our sponsor of today's show, Avicanna, because we think there could be a massive breakout coming there. I'm going to show you that chart again here in a moment, but sitting in that supply zone and a breakout could yield a potential 80% move. But let's talk about what's going on with Avicanna, because they are changing the game. They are a global leader in cannabinoid-based medicine, bringing innovative products to millions worldwide with a strategy that's gaining attention fast. And again, everything you need to know in the pinned comment and description below. Because the global medical cannabis market is booming and now projected to reach $37 billion in 2024 and grow to $68.6 billion by 2033 at a 7.1% annual rate, with cannabinoid pharmaceuticals exploding to $102 billion by 2030. And Avicanna, they're right at the heart of this massive expansion. And they stand out with 4 solid business pillars, including medical cannabis products like RHO Phyto, the Metre CA Care platform, a promising pharmaceutical pipeline, and low-cost active ingredients from their Colombian farms, which are delivering over 45 proprietary products to patients everywhere. And through RHO Phyto and myMedi.ca, Avicanna offers evidence-based solutions for pain, anxiety, and more, with pharmacist-led support reaching over 75% insurance-covered revenue, helping patients access safe, effective cannabinoid therapies like never before. And Avicanna's drug candidates target big needs like epilepsy, pain, and skin conditions. TrueNox for seizures is already approved in Colombia, and a new phase 2 trial for osteoarthritis pain starts this fall, backed by top researchers and funding. And fresh off Q2 2025 results with $6.16 million in revenue and 51% gross margins, Avicanna secured a key U.S. patent for topical cannabinoid gels treating acne and rosacea, strengthening their edge in skin health and beyond. And operating in over 22 countries with exports to 19, Avicanna's sustainable Colombian farms produce premium CBD and THC at under 10 cents per gram, fueling affordable, high-quality products while tapping into multi-billion-dollar international opportunity. And in a competitive field, Avicanna shines with their science-driven focus, robust IP, and their first profitable quarter in Q1 2025. They're now poised to lead as the cannabinoid market surges toward $444 billion by 2030. And with strong partnerships, ongoing trials, and a clear path to more approvals, Avicanna is building a powerhouse in cannabinoid medicine. Watch as they transform lives and capture a slice of this explosive global growth. And something else they could transform, that is your trading account. Let's take a look at this chart, because again, when they're trading down in the supply zone, you can see the stock tends to break out. Now, right now it's closed just over its 2-year volume profile. And this, my friends, is where the opportunity is at, because you can see that people have been accumulating shares down in the supply zone. Now, if it were to break out and move past that mid-supply zone all the way into the upper one, you're looking at a potential 80+% move. Again, everything you need to know in the pinned comment and description below. Dive deeper into Avicanna's story at Avicanna.com. Discover how their innovative approach is reshaping health and wellness worldwide, and be sure to check them out on the TSX on symbol AVCN and on the OTCQX on symbol AVCNF. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.